Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the US trade wars, the US announced it had reached trade agreements with both Japan and the European Union. In these deals, both countries will now face a 15% tariff, down from the threatened tariff that President Trump announced just a few weeks ago that were set to come into effect on August 1st. Importantly, the reduced tariff level of 15% that these exports will face also includes the auto sector, a key sticking point in negotiations. Alongside the tariffs on exports from those countries to the US, both Japan and the European Union agreed a level of investment into the US, up to $550 billion from Japan, and upwards of $600 billion from the European Union. Now, a few details have been released on how firm those investment guarantees are, and a lot of questions have been raised of how much of that will end up materializing. But nonetheless, it appears that both Japan and the European Union had to make these, quote, concessions in order to reach the lower tariff level set by the US. Overall, markets reacted positively to the developments and the agreements being announced, and it is likely that these deals will help improve the global economic outlook moving forward, and in turn improve and likely increase demand expectations for fossil fuels and other commodities. Also, regarding Japan, the upper house elections were held this past week, and for the first time in 70 years, the ruling LDP party lost its majority in the upper house. This will intensify calls for political renewal and party leadership change, and there are already reports that current Prime Minister Ishiba is set to step down in August, amid the trade tensions with the US and other global issues. Weather. Moving on to the weather news, weather forecast for Europe over the next 7 to 10 days point towards mostly below average temperatures, particularly through the beginning of middle of this week. Now, as we move into the beginning of next week, we'll start once again seeing those above average temperatures start to sweep from southern and western Europe. In terms of precipitation, higher levels of precipitation forecasted throughout this week and early next week, particularly across Western and Northern Europe. And lastly, in terms of average wind speeds, the forecast still calls for relatively lower wind speeds across Europe, likely keeping wind power generation from increasing further. In terms of the Atlantic tropical weather outlook, no tropical cyclone activity is expected over the next 7 days in what continues to be a mild start, an uneventful start to this year's hurricane season. Crude oil and LPG. Looking at crude oil markets, we note the relative stability in crude oil prices over the past week, certainly compared to the large volatility that we saw previously. The stability is owed largely to less news coming out impacting oil markets and an overall more optimistic sense of the situation, particularly given the expected increases in global supplies as OPEC Plus continues to ramp up production quotas month after month. On the demand side of things, while we still see the various trade wars that the US has initiated weigh on global future demand expectations, the deals reached with Japan and the European Union, among other countries, is certainly helping to add support to those demand expectations. In terms of the global petroleum balance outlook, we see a relatively unchanged demand forecast compared to the previous month, and it's on the supply side where we see the biggest changes, particularly coming out of the continued OPEC Plus decisions to increase production quotas. Overall, the current forecast is for oversupplied crude oil market through the rest of 2025 and through 2026. Natural gas. Moving on to natural gas markets and looking at the TTF price evolution as a reference for European prices, we note the relative stability over the last week, in particularly compared to some of the volatility we've seen in the past. Taking a closer look at the price evolution over the past week, we note limited downside, particularly over the remainder of 2025 and beginning of 2026, with the forward years seeing relatively small movements over the past week. The stability in markets is largely due, again, to the more balanced outlook regarding supply and demand over the past week, limited the movement in the market. In terms of gas storage levels increased to just over 67% as of the end of last week. And as you can see here, remain noticeably below not just last year's levels, but also below the average since 2012. When we look at the injection rate into storage, we know that it's still above the average since 2012, even if just slightly, but we've generally seen slower injections into storage over the last few weeks compared to earlier this summer. The impact has been that while the storage deficit versus the previous year has continued to narrow, it has only done so very slightly. So at the end of last week, the deficit versus the previous year remained at 17%. In terms of total supply and demand, the situation remains relatively stable over the past week, with just a slight uptick in the total supply situation owing to an increase in Norwegian gas flows, while total demand remains pretty stable over the past week. In terms of the supply mix, as we noted, we do see that slight uptick in Norwegian gas flows. That's following that temporary dip due to some outages. And the expectation is that we'll continue to see a further increase in gas flows from Norway in the coming week, pushing it up closer to the highs that we saw earlier this year. The other major source of natural gas into Europe, being LNG sendouts, have continued to come down over the previous weeks, particularly over the past week, pushing it below the highs that we saw in 2022 and closer to levels in 2023, although still notably above last year's levels. In terms of price competition with Asian consumers for LNG, that has intensified over the past couple of weeks owing to the higher temperatures across Asia, which is increasing cooling demand and as a result, increasing gas consumption in the region. That, alongside the slightly faster and greater price decreases in Europe, has led to a widening of the gas price premium in Asia. And as a result, we are seeing a lower share of global LNG exports going to Europe with a higher share going to Asia. Coal. Looking at coal prices there, we note the limited movement, particularly when it comes to European coal prices, largely due to the stable evolution seen in the gas markets, as well as the limited increases we've seen in coal demand expectations. Coal stocks at ARA terminals remain at comfortable levels given ongoing demand, and that has reduced demand for additional imports. One outlier is the increase in the Newcastle coal prices, owing to the increased coal consumption and demand out of Asia, in part due to the warmer temperatures, as I mentioned earlier. EU and UK emission allowances. Looking at carbon allowances here, we note the slight uptick in the market for both the European and the UK side of things. On the UK market, the slight upward movement over the past week appears to have been driven in part by the announcements that the European Union and the UK are moving closer to linking their emission trading schemes, adding upward pressure to the UK market. On the EU side of things, last week's auction of 13.4 million allowances saw weaker demand that some had anticipated, with a cover ratio of around 1.7. Overall emissions remained lower than previous years, easing demand for allowances, but the prospect of hotter weather forecasts in August are still keeping that demand at higher levels. In terms of those power sector emissions, as we can see here, while those have remained near the bottom of the range since 2019, we have seen that steady upward movement during this summer as higher temperatures have led to additional consumption and demand from the power sector. In terms of investment fund positions, those we've seen come down over the past week, in part due to the slightly cooler temperatures, particularly over the course of this week, easing emissions from the power sector, as well as the slight uncertainty over future economic conditions, as this data does not include the recently announced trade deal with the US. Electricity. Moving on to electricity markets, and looking at the German power market, we note limited movements over the past week, both on looking at the quarterly products, but also along the forward curve to the forward years. The forward year product increased by just 0.2% over the past week, very much indicating the limited movement in the market. Looking at other markets across Europe, we note also the limited movement there, with most markets continuing to follow a close evolution as the German power market. Over in the Nordics, we've seen slightly more upside in the market owing to the hydrological deficit that the region is facing, even as hydro reservoir levels across the region remain sadly above average. Looking at total demand and residual load there, we've seen that total grid demand come down over the past week, very much driven by the cooler weather we've been having, while residual load has remained relatively stable over the past week, still at the lowest levels over the past 5 years. In terms of the supply mix, we've noted now the slight uptick in the share of nuclear owing to the improved performance out of the French nuclear fleet, as well as the continued upward movement in the share of solar as we continue to reach new record high levels of production. On the other hand, the decreases in both hydro power generation and wind power output has added support for the gas-fired power generation as well as for coal. In terms of nuclear power generation, we've seen French nuclear output increase noticeably near the top of the range over the past 5 years, and while we did see a slight dip over the past week, expectations currently are for a further increase in output over the coming week. In terms of renewable power generation, we've seen that come down over the past week, slightly below the highs seen last year. On the other hand, fossil fuel power generation has seen a slight uptick to compensate for that drop in renewable output. In terms of renewable power generation, while there was a slight improvement in wind power output, that remains relatively low, certainly compared to earlier in the year. More surprisingly was the decrease in solar power output, which dropped rather sharply from record highs just a few weeks ago now to similar levels as last year. The consequence of the decrease in renewable power output has been an increase in the share and output needed from fossil fuel power sources. Most notably has been the uptick in fossil hard coal generation over the past week, increasing from the lowest levels over the past 5 years to now more in line to the levels we saw in 2023. Looking at gas generation, there we see a pretty stable evolution over the past week, still at the bottom of the range over the past 5 years. In terms of hydro reservoir levels, as I mentioned earlier, particularly in the Nordics, we're still seeing above average levels, but nonetheless, the higher temperatures this year has led to a greater level of evaporation. As a result, we are still seeing a hydrological deficit in the region. Lastly, looking at the price evolution for guarantees of origin, following that sharp uptick a few weeks ago, we've seen a continued decrease in the price level, with prices decreasing rather sharply over the past week across guarantees of origin types and years of production. That covers this week's market presentation. Thank you for joining.